Welcome to the October 8th Portfolio Builder live premium webinar. We'll start off looking at our profit loss per strategy in October and then deep dive into what's the most important topics to focus on as we close out the year. Our high risk, high return portfolio is now up 17% in October. The Safe Alpha, which is very similar to Berkshire Hathaway or Warren Buffett's, up 6% in October. Safe Growth Pro, the Ray Dalio global stock portfolio, highly diversified, really good for seven-figure accounts, up 6% in October. And our Bootcamp Core strategy now up 9% in October. So just blistering returns. If you're on a free trial with Portfolio Builder, welcome. This is our paid premium webinar that you have access to for a short period of time. And that's only a one-time opportunity. The portfolio you get access to is called the High Risk, High Return Portfolio. It's now up 271% year to date and has increased its gain by 20% since our last update on Tuesday. And get this, it is smoking the S&P 500 17 times. So main message today is buy, buy, buy. Get into any one of our portfolios. They're positioned perfectly for what comes next. If you're already following, it means just sit back, relax. We have nothing to do. No changes anticipated till late November or December. And that's because our predictions came exactly true, and we've been well rewarded for that. So prediction one on Tuesday, October 5th, is that the debt ceiling would be lifted and that spending will go through and stocks, commodities, and crypto would go higher. We nailed it. Mitch McConnell caved yesterday, giving Democrats what they desperately need, $500 billion in extra debt issuance to kick the can to early December to pass stimulus. So the big problems are not resolved. They've only been delayed, which is exactly what we predicted. Prediction two on Tuesday, October 5th, was that we'd get a weak jobs report Friday, signaling the Fed tapering could very well be delayed. Now, the big banks are still saying they predict a taper in November. If they do, and I'm right, and we get another weak jobs report this month, this could be a massive policy mistake and cause a stock crash. So we will be ready for that potential stock crash as we approach. And another good reason why you want to be a paid member so you don't miss these critical trade alerts. And we nailed it. Today we came in with 200,000 jobs instead of 500,000. And again, remember, they were promising us 1 million jobs a month. We're nowhere near that. Between mandates, more people getting sick, poor economic policy, there just really seems very little probability of a robust economy anytime soon. Now, the market rewarded our NRGU oil position today and all week as inflation is truly out of control, as the economy stagnates and GDP stalls. A month ago, these guys were predicting 5 to 7% Q4 GDP growth. Now it's down to 1.5%. Now, I actually would have anticipated our tech stocks doing the best on this horrible jobs report today. But instead, our NRGU position is climbing towards 200. And I remember people asking us if we should sell when it was at 100 just a few weeks ago. And we told you, absolutely not. This is your single most important position. Here's a look at that chart just from the last few weeks, skyrocketing NRGU, sky high. Now, this is the top 10 oil and gas companies in the US, leveraged times 3. So it's a critical position that's in every single portfolio we offer. And this is going to be a multi-year trend. Now, here's a risk on the tapering side. There's 7 million Americans who've lost unemployment benefits 2 weeks ago. Will they return to workforce in October? If they don't, there probably will be no November taper. Now, again, it's 7 million people that are going to run out of money and need to find a new source of income. If it's going to happen, it's going to happen in October. We're actually going to anticipate very weak labor growth in November, December, January, based on some problems with the healthcare system, which we'll reveal once we jump into that section of the presentation. So October is a big risk month for a huge gain in jobs. We will see. Biden's on TV right now, blaming the poor labor recovery, probably on the people who haven't taken the recommended medicine, maybe, and for because Congress won't pass his Build Back Better agenda. I'm sure that's what he's talking about on TV right now. We'll cover it more on Tuesday. But there's a big chance jobs do come online in October. They should. If they don't, we know mandates are probably really hurting this. And again, poor economic policy decisions. Now, if the tapering is not going to occur, we're going to anticipate rates stay low and long duration assets continue to do well. Now, we don't like the US Treasury market because inflation is way above the interest rates. So this forces us into the tech stocks and the cryptocurrencies. And so if you're in our high risk portfolio, you know, one of our single most important positions is the Ethereum. This is something like investing in Microsoft when it was only 5 years old. Okay, so they're building out a operating system that can compete with centralized operating systems. So very good news flow coming for Ethereum as they switch from proof of work to proof of stake. And this looks like it's getting ready to skyrocket higher. Can Ethereum overtake the market cap of Bitcoin? And if so, we could see Ethereum go up 10 to 20 times from where it's at currently. Now, we will review the asset allocation breakdown and detailed monthly profit loss at the end of this video for each strategy for anyone who's on the active trial or a paid member. If you're watching this on YouTube, though, that section is going to be cut off. That's how we motivate you to upgrade. And you can call John now to upgrade so you don't miss out on our trade alert. If we get a poor labor recovery in October and the Fed tapers simply to fight inflation and to help put pressure on Congress to pass this new stimulus, we could very well get another volatility event, and we will prepare you for that moment in time. So call John right now at 505-610-1334. He will take your call over the weekend. Okay, and if you notice, Dean takes your calls during the weekdays, and we've got John ready to support you on the weekend. So we're here to take care of our clients every day of the week. Now, we would like you to help us boost our YouTube rankings by liking, clicking the subscribe bell, and leaving a comment below. This helps get our video high up in the search rankings. And I'm also going to start reading the 3 top comments every episode and pay out a $100 reward. So go leave a comment below and let us know what you think of this content. I'll be reviewing a bunch of them in every episode, and again, rewarding you with a $100 bonus. So we'll look up your YouTube ID, private message you, and get you that bonus payout. And this is, again, every Tuesday and Friday, you have that opportunity. So read everybody's comments below and leave your own comment, like, share, help us out. Okay, let's talk about key market risks to focus on. It still remains this: Jayapal and Bernie Sanders are teeing up against Manchin and Sinema. So we've got all of the Democrats except for 2, maybe there's 5 others that are really behind Manchin. Bottom line is they're having a really hard time agreeing on how to spend money. And this could cause an epic stock market crash. When you realize how leveraged the market is and how reliant the US economy is on government transfers, it's absolutely critical they keep the money flowing. I believe the September sell-off was only a prelude to a larger potential crash in December. The debt ceiling and new spending continue to be blocked. So what McConnell has given the Democrats as a lifesaver was extension of $500 billion, which gets us to December, and then we're going to be right back to exactly where we were just a week ago, where we had markets selling off and this huge fight over the debt ceiling and how to spend the money. So this is, again, exactly what we were expecting. Now, my prediction is we're going to see a $1.5 to $2 trillion deal passed in December, that they will come to terms. and that the timeline is going to be faster. So we know Biden, or really Janet Yellen, was screaming that we need $3.5 trillion, but that was going to be spread out over 10 years. I believe they will shorten the time frame to end right around the 2024 election to keep the money flowing aggressively into the economy. It's really the only chance, in my opinion, that the Democrats can maintain control of the House and the Senate as we head into the 2022 midterms. Now, right now, I have a gut feeling we're not going to taper in November, and it's potentially going to be a huge policy mistake if we don't have robust labor recovery in October and they begin to taper in November. So we'll have to just keep a very close eye on this. And again, failure to close a deal in December will likely cause a stock crash. And our clients don't need to worry about this because you own UVXY, the VIX. This position protects us with up to 1,000% or higher gain in the event of a crisis. Now, in March of the lockdown, which we predicted, a small 10% position in UVXY went up 1,100%. So you could have had 90% of your account go to zero, which didn't happen. And that 10% insurance policy netted you a 10% gain. Right now, we're not at 10% because I didn't think we would have that big crash right now, and that the more likely timeline is December. So we'll keep a close eye on that. Meanwhile, the bad news out of China keeps pouring in, but in general, Chinese imports and exports are at record highs. And news, Charlie Munger, Buffett's partner, doubled down on Alibaba, which we already have huge exposure to with EDC, which gives you 3 times leverage into emerging markets, ETF, EEM. And then we have FNGU, which is in our core strategy. So in Pro, you have EDC, and in the Bootcamp Core, you have FNGU. And I do want to actually add exposure to our emerging markets position in the near future. So that's a trade alert I'm looking at. Now, I do find that it could be ironic for China to crash the global financial markets in an effort to clean up their economy on the back of their best year economically in history. And who's to say that's not part of their plan? So we're keeping a very, very close eye on what's happening in China. We are at very critical levels in both the dollar against the euro, as well as Chinese big name stocks like Alibaba or Tencent, or just the entire EEM, emerging market sector altogether. Now that did bounce back above 50 on EEM, below 48. I will get worried that we have big problems coming out of Asia. Now, if a true recession is coming, and it's not just mere manipulations due to politics, I'd actually expect to see the price of oil and other energy commodities to fall. Instead, they're going higher. And that's the main reason why I was calling the bluff on that recent sell-off in stocks. And again, rather than energy falling, showing recessions coming in, we've seen the prices roaring to unsustainable prices due to high demand and supply chain issues. So inflation eventually leads to deflation. Now, meanwhile, shipping prices and times remain at record levels as well. We have seen a little bit of a pullback in shipping costs, so we are starting to see a little slowdown. But what's going to happen when we pass $2 more trillion? This is all going to continue to be aggravated. So in general, what I see is a slow but steady reboot of global economies as the sickness, now note we can't say the real word, will get censored, slowly becomes less and less of a burden on society. My core prediction remains that we will have a slow motion, multi-year rotation out of growth and into value. And it's going to be pushed by high levels of fiscal spending through the 2022 midterms, and that we're going to hit a top and tightening in 2023 that causes a stock market, crypto, and commodity crash. This will be done briefly before massive stimulus and QE pass into 2024 presidential election. So I think they will have to fight off inflation with monetary policy, but that they're likely to do this after the midterms, not before. So early 2023, I think is going to be a very important time period to get ready for volatility. So in other words, right now may be the best time ever to start following any one of our strategies, because what's coming next is likely more money printing, a very loose monetary policy. So with that said, we still need to be on high alert. October through January, markets could experience extreme volatility caused by the government or the Federal Reserve. So just to review, if the government can't pass spending by mid-December, we've got big problems on our hands, as well as keep making the debt ceiling go higher. On the Federal Reserve, they're in a tight spot. They have a weakening economy that's crashed from 7% GDP expectations in Q4 to 1.5%. They've got labor markets going the opposite direction. And then they have inflation skyrocketing out of control. So if they remain dovish, the inflation story keeps pushing hard, crushing the profit margins of companies, making wages go higher, causing all sorts of problems. On the other hand, if they tighten while the economy is weak, they're quite likely going to create a financial crisis, recession, and maybe even a depression. So we'll pay close attention to this. Now, based on the Israeli data, another market risk to add fuel to the fire will be that the medicine being used to fight the sickness, it's now clear, there's no question, it has nothing to do with variations in the sickness or mutations. Zero. After 3 to 4 months, the medicine does not work. This means there will very likely be a lot of sickness and overloaded hospitals, causing fresh new lockdowns starting in early to mid-November through December. Okay, so that's something I think is going to potentially be a big problem if the government can't pass stimulus, and could be used as a political card to help create a crisis and push this spending through. So keeping very, very close. Right now we're in the quiet before the storm. Seasonality says we shouldn't worry about that sickness until mid-November. We'll look at that chart in a minute. So again, there's a lot of fast moving parts. If you want to get critical trade alerts timely, upgrade now. Call John at 505-610-1334. He'll take your call over the weekend and get you signed up. Okay, now big picture, 3.5-year bull market in energy companies. Here's XLE. We got to review the big cycles. We had the dot-com crash. They did slow down spending from 2000 to 2002, and you had a 2-year stock market crash. Then they quickly reversed that. The big trend is after every big crash, we double our deficit spending. So we went from $250 billion after the dot-com bubble, prior to the dot-com bubble. After the dot-com bubble, they jumped it to $500 billion. After the great financial crisis 2008, they went up to $1 trillion a year in deficit spending. And now, in the last year, we did a $3 trillion deficit spend. I don't think they can pull that off, but they're probably going to be in the $1.5 to $2 trillion deficit spending here on out. And if they fail to accomplish this, expect market volatility. Okay, so it's very, very hard to walk back spending once it's been approved, and the government and the society become addicted to those spending patterns. And so the net effect is you end up with the Fed suppressing interest rates by buying our own debt, and this makes the inflation story skyrocket. And the best way to play inflation is to bet on the oil and gas sector with XLE, or we like NRGU. Now, when stimulus passes, expect EDC or EFO to outperform UPRO. So EDC is Asia, EFO is Europe. And let's just review the last two packages that got passed. We had $1 trillion in December and another $2 trillion in late January, one with Trump and one with Biden. And what do you know? Emerging markets had a 30% return relative to the US having only 19. And Europe had 24, so extreme outperformance. Now that trend reversed for most of the year as they failed to spend money, and now our economy is at a drag. And again, the big problem was that they did the stimulus, which helped, but they didn't get the economy and the labor markets recovering. We really needed to be gaining 1 million jobs a month. Right now we're averaging 500,000, and the last 2 months have been pathetic, closer to 200,000. So why? Well, we were paying people to stay at home, and we've been punishing companies and labor markets. So we'll see if this can start to heal. And October is going to be very, very important. Remember, there's now 7 million people who've been cut off the free money, likely looking for a job. Now, the other big thing is to expect interest rates to rise. And again, this growth to value rotation. So if you were only long tech back in February, I'm sure you felt some pain, or if you're in Bitcoin, let's just look at what happened. In the yellow line, interest rates went skyrocketing up as we passed stimulus after stimulus. Okay, so more supply, higher interest rates. And then you can see energy followed those interest rates just like a magnet in the green line. Now the NASDAQ did sell off 10%. So that's what we're going to expect soon as stimulus comes through. The market's going to probably front run this. And again, I expect this to go through by mid-December to be about $2 trillion. So that is exactly how we are positioned currently. Okay, very good. So now what we're going to do is look at some charts, some data, the news, and then we're going to cut off the recording for the free version. And after that, we'll go into the exact asset allocation per strategy and answer any questions about how to become invested in the portfolios. Okay, so let's start off looking at the big markets that we're interested in. So I'm going to go ahead and hide the NRGU, and I'm going to go ahead and look at this zoomed in. So most important line to start off at is the gray line. This is interest rates. If the gray line's going up, interest rates are rising. If the gray line's going down, interest rates are falling. And so if we zoom in to where the interest rates were rising, we can see the Russell 2000 did well. The emerging markets were doing well at first until these rates went skyrocketing. We can see that the orange line, the European market, was doing well. I'm going to actually hide a few of these so it's not so hard to watch. Okay, so this is a lot easier to understand. So the timeline was we passed stimulus in December and February, and all of a sudden the bond market crashed, interest rates went rising. The NASDAQ sold off and our oil and gas play went parabolic. Okay, then what occurred was we had no labor recovery. It was half the speed we expected. Lots of problems, a new wave of sickness through the summer, lockdowns through Asia, the whole global economy slowed down, interest rates globally fell, and you had tech stocks benefit in purple, energy stocks pulled back. Okay, now that was somewhat unanticipated on our end, but we believe big picture was that in general, the economies will reopen and that we are going to have a recovery, and the bigger play is the inflation. And sure enough, all of a sudden, our oil and gas play has just skyrocketed. We have interest rates beginning to rise again and tech performing very weak. Okay, so I think we're about to hit a huge catalyst to further exaggerate this trend. Okay, next I want to look at the Russell 2000. This is Stanley Druckenmiller's favorite way to predict markets. Not giving us a signal to buy or sell. It's really just trading flat since February. It's just been really stuck in nowhere land. I believe this is getting ready for a significant move to the upside based on exactly what we've been talking about, passing stimulus and recovery of the economy. Now, if we look at emerging markets, we can see this has been the big surprise. We had this huge return in emerging markets all the way up to February. Interest rates went rocketing, the dollar went up, government failed to pass more stimulus and spending, and emerging markets been crashing ever since. Now, again, I believe this is primarily due to lockdowns, to China trying to curb inflation and force their economy to spend money in certain ways that they prefer, So what we've seen China do is go really pull the rug under a lot of bubbles in their economy, in their education sector, in their tech sector, and in their housing sector. And this has been at the cost of foreigners losing trillions of dollars. They're laughing all the way to the piggy bank, probably. It's called smash and grab. They smash their own assets so they can grab them back up. And again, I believe this is probably your single best performing asset outside of the oil and gas play for an index over the next decade. So we're getting very bullish on that by the dip. Okay, here's a look at EFA. This is what we're playing for Europe without the leverage. So as you can see, this has been doing extremely well. It had a pullback here since June. And again, I believe it's getting ready to break to new highs. We're playing this with EFO in the Pro, so you get some leverage on that. Okay, very good. So those are the big markets we're focused on. Now we're going to look at some alternative inflationary plays or growth plays. We're very bullish on Bitcoin in our Bootcamp core. We have Bitcoin in all portfolios except for the high risk strategy. High risk strategy is betting that Ethereum is a far more lucrative investment. Now, Bitcoin's neat that it's deflationary and a store of value. It's a replacement to gold. Some people look at it as a real estate play, limited supply, 21 million. Half of them are locked out and will never be regained. Big question, what happens when you run out of Bitcoin? How are you going to pay all the miners? So that's something I haven't heard a very straightforward answer to. Good news, that's decades away from current. Ethereum, however, is a lot more than Bitcoin. And it's really predicting that it can reproduce just about every technology that we use today in a decentralized manner. So this could be a new app store, this could be a new web browser, a new internet, anything that's technology based, programmable, can be reproduced on Ethereum, and its competitors are Cardano, Solana, Polkadot. So it's a big if, but if this does happen, because centralized systems continue to abuse their power, the opportunity for Ethereum to overtake Bitcoin's market cap is massive, and it could send Ethereum from this 3,500 level to way over 30,000. So this is our high risk strategy that plays Ethereum aggressively. And you can see it's outperformed everything in this inflationary alternative investment group comparing gold, silver, Bitcoin, and Ethereum, but it's come at a pretty heavy duty volatility. So you can see this huge sell off here, this huge rebound. What comes next? I believe this is getting ready to see Bitcoin go higher first, then Ethereum chases it, and then the altcoins chase Ethereum. And that's the order I'd anticipate this melt up to occur. Okay, on the defensive side, which we don't want to be long yet, we have a small UVXY VIX play. It's been there to protect us against a disaster, but we've been relatively light below that 10% threshold to be completely protected. And again, it was the right call not to get super nervous right now because we knew it was unlikely anything would pass till December and that the politicians would kick the can on the debt ceiling. So far, we've been correct on that. The other plays we like are being long treasuries. If we're really going to fail to issue more treasuries, there's going to be a limited supply and global demand. So we play that with TMF. We've been staying away from that currently because inflation is way over the interest rate on bonds. I do believe bonds can be a really important play, but probably not till 2023. So that's actually when I think we'll be loading up on bonds. Now, again, if we do think there's a crash this winter, my plays are UVXY, TMF, and EUO. So EUO is a bet on the dollar against the euro. TMF is a bet on interest rates falling on the long end of the treasury curve. And UVXY is essentially put options that are out of the money that automatically recalculate for you. So just a beautiful combination of defensive plays we can allocate to in a snap if we think there's problems coming in. So if we taper November 3rd, that could be big problems. So we got to be watching this economic data in October really closely. Usually labor data is boring, not important, but this month it is going to make or break this decision on tapering. Okay, very good. Now in Bootcamp Core, we have a few other aggressive plays. We have uranium, which we're getting ready to go long. It had a little sell-off. This is going to be a long-term play. Nuclear power is the only way we get to carbon neutrality by 2050. So I love that play, getting ready to issue a trade alert for that. I'm probably going to dump our NJ position. We've been patient forever. Might leave a small position in it. It's just been really not getting that hype it needs to do well. Uranium's getting pushed by Bill Gates and this big globalist agenda. So I think that's a easier, safer way to make money on an alternative energy investment strategy. The other play we have is TAN. TAN's been selling off due to restrictions on China, but that's the solar panel play. Again, if we're gonna get to carbon neutrality by 2050, TAN and REMX and uranium are going to go parabolic to the upside. So those are all plays we have. And actually, let me add REMX. So REMX is our exposure to lithium, which is critical for batteries. And it also has all these rare earth metals used. Again, all of this is necessary for tech, for batteries, for clean energy, renewable energy. So these are the plays we're looking at. And I think we're probably getting to the point where we want to reduce some of our NRGU position and buy the dip on this REMX and maybe some of our tech companies. So not making that trade alert yet, but that's another trade we have in mind. Okay, here's the dollar index, DXY. This is at a very nervous level. If this were to break higher, that would signal there's big problems in the financial system. Our portfolios are doing well with the dollar going up, but we're positioned for the dollar to fall long term. So what I'm anticipating is the dollar is going to fall, come back down towards this 90 level, and that's probably going to be when we want to pull some profits off our oil and gas play, and then start to look at how to reposition. So to see NRGU nearly double while the dollar's rising is just unbelievable. Wait till that dollar falls, and you're going to see that thing really take off. The other currency we're curious about because of the Evergrande defaults, China's suspicious behavior, is the yuan. So if we were to see the yuan devaluing, that's typically caused market crises. And right now it's just staying stable. So oil's not falling, the yuan's not devaluing, imports are at record levels. So the only pain we really see in China are specific markets that the government's targeted. And so it's just been smash and grab politics, nothing really to be concerned about. So I don't think China's about to cause a big crash at this point. Okay, there's the energy sector and the cycles, which we've covered. Over in Bitcoin land, we're playing Bitcoin and Ethereum with our paid products at Portfolio Builder. I'm a big fan of hedging your risk against Cardano, Solana, and Polkadot, giving Ethereum a run for their money. So we have a private equity offering called Rebel Dividends. If you're interested in that, let us know. And then we're also betting on PancakeSwap and Polygon. So those are the other two positions we have. So Polygon is the layer 2 solution for Ethereum. Also lets you get money in between Binance and Ethereum. So really neat. This is actually one of the best performing cryptocurrencies of all time in the last several years. And then way down here, we have PancakeSwap. So with Binance getting kicked out of Western societies, people are going to PancakeSwap, the DeFi for Binance. So this is gaining lots of users. The more bad news you hear about Binance, the better it is for PancakeSwap. And they're paying out a 92% staking reward just to buy and hold this asset with a 4.5 billion market cap. So those are my favorite cryptocurrencies that we're keeping a close eye on. Here's a look at these returns that we've seen in the most recent time period. And again, you can see that Bitcoin's leading the way up 30%. And then the rest are trailing right now. So we've got Polygon up 26, Ethereum 24, Solana 21, Polkadot 21, Cake 7, Cardano 6.5. So I expect Bitcoin to burst higher, stabilize, Ethereum to burst higher, stabilize, and then altcoins to chase after that. All right, so what about lockdowns? So the data of Israel's finally started to crash. This is good news. The timeline was they got the medicine double dosed by February. 6 months later, cases went parabolic. I'm anticipating the same thing's going to happen in the US starting in November, December. So we'll keep a close eye on that. But as expected, it did crash, and right now it's not a main concern. Vermont, the most medicine state in the US. Same thing. Look, more cases than they've ever had. It's starting to fall. I believe this will continue, and that we shouldn't be freaking out about lockdowns for about another month and a half or two. Okay, the week over week changes in the medicine or the sickness cases are crashing, exactly what we anticipated. So again, so far nothing to freak out about that. And here's the trend that happens every year for the last century. Hospitals get overwhelmed from November through early January. I believe that's going to repeat itself and could be used as a political weapon to cause lockdowns and help push the big stimulus through. So that's a big risk coming at us in November, December. Now, this is why we know it's not the mutations of the sickness, that it's the medicine waning. UK had its independence opening in July as the variation was spreading rapidly. Everybody thought it was going to be this huge disaster, but because the second dose had just completed, they opened up, nothing went poorly. And again, we can see it's the waning effect of the medicine. It's not these mutations. That's completely off. Now, big picture, this is probably the last time we've really got to worry about this nonsense. India doesn't even use the medicine. It came, it whipped through, they did fine. And again, in general, we're going to see global immunity, and that every year this is going to become less and less of a problem. So looking forward to that. On the VIX term future, we're looking at the dots jumping. So October to November, you can see the dots jumping the most. Okay, this is getting worried about tapering, I believe, which would be caused by a strong labor recovery. And then the next big jump in the dots is December to January, which is when we need to see stimulus pass. So in general, to not have a volatility event, we probably want a weak October labor recovery, no tapering, and then pass stimulus in December. Okay, so that's the 1-2 combo punch to keep the market melt up continuing. Okay, reverse repo is what we're looking on this screen, $1.37 trillion. This tells us there's very, very little risk of interest rates rising right now. Banks are desperate to get their hands on our debt. We're not able to issue the debt. Now we can issue another $500 billion. So that's coming through the pipeline. So we'll see if this reverse repo starts to fall. If it goes below 750 billion and we're seeing robust labor recovery signs, we may want to reduce exposure to tech stocks. And again, your oil and gas play is going to save your butt. Okay, so these leveraged XLE and NRGU charts can be very misleading. NRGU looks like it's going to break to a new high. Should you freak out and sell? Well, let's look at what we're holding on the underlying. The underlying top position is Exxon. And so I'll get more concerned when the price of oil goes towards 120 and the price of ExxonMobil gets to recent highs. So if we see the price of oil go above 120 and we see Exxon go towards 100, we got to get out of NRGU, pull some profits, just not get too greedy. Could this break into new highs? Sure. So we'll play this as we go, but I wouldn't be selling your NRGU right now based on that. Okay, now this was a fascinating chart that had us scratching our heads. So we know interest rates and the price of oil are highly correlated. And so why has the price of rates gone down while oil went up? And so we've been telling you likely that trend would not continue, that either rates go up or the price of oil goes down. We know that oil has the government trying to suppress it so that they don't have to have everybody squawking about inflation and slowing down spending, their worst nightmare. And we know that the Fed's trying to suppress rates. So we look at oil as a much better barometer of the health of the economy. And again, this inflation story is just out of control. So the Fed's just in a very, very tricky position here. Okay, natural gas has been going parabolic, little sell-off here. Copper futures have stabilized, but at very high levels. So we're keeping a close eye on this. The lumber story crashed, but now it's starting to rise again. So I believe we are not out of the inflation story yet. There's the Baltic Dry Index, a measurement of shipping costs, again at record levels. So again, these are things we'd expect to fall if we were heading towards a recession. So here's a look at bonds over the last 40 years. Interest rates go lower, government expands debt. If the government wants to continue to expand its debt, in the long run, these rates have to go lower. And that's because nobody wants to make a lousy 2.1% per year for 30 years when inflation's at 5 or higher. So the only reason you would buy these assets is if you're a bank and you got to pay interest on deposits and you don't mind holding it for that period. But again, are you going to lose money overall? Well, the only way you make that up is if these rates go lower over time. So it's going to be problematic. I think this is the single biggest risk to markets is interest rates are going to rise as the government has to borrow tons of money and they want to borrow it at rates that are too low. So I expect rates to rise till about 2023, and then we're going to be aggressively building into a treasury position. I think that our top price will be no higher than 3% on that 30-year, and we'll be buying as we break beyond that recent high of 2.4. Now, I think timing again is later next year or even 2023 before we start to get to an attractive level. Gold copper ratio, Dr. Copper, Jeffrey Gundlach's always showing this chart off. Just want to give you a feel for how long these trends can continue. Copper rose at a faster pace than gold from 2002 to 2007 till rates went so high that the housing market popped, and then it reversed course quickly and crashed hard. So I do believe we're getting ready for the next leg higher in the gold to copper ratio, and this will be pushed from stimulus passing. Okay, next chart, we got the bond markets, TLT, JNK, and LQD. So TLT funds the government. If that's crashing, problems for the whole economy. NRG is your hedge against that. If we see LQD or JNK crashing, that means that corporations don't have access to borrow money for stock buybacks. So another problem. Right now, they're trading relatively flat, although you can see they've begun to sell off. So nothing to freak out about right now. Next slide, we keep a close eye on all the debt being issued by the Treasury, with the debt ceiling likely being lifted $500 billion this week, and the House has to vote for it now. Senate passed it last night. We're going to see some pressure come. So we're going to see some debt getting issued to fill up the Treasury with cash to get us through December. So we'll see how rates behave, but I would anticipate that based on the reverse repo at 1.3 trillion, rates should just trade flat. I don't think they're going to go up on us right now very much to cause problems. Okay, here's the non-farm payroll, just very, very weak. So just the labor markets are weak. Inflation's way above the 2% target. And again, this is going to eventually cause the Fed to raise interest rates to suppress inflation. I think they're going to wait till 2023 to do it aggressively because the economy is not strong enough to hold any kind of monetary tightening right now. Banks are lending money out. This is very good news. Here's the bigger picture. You can see banks need to grow credit. They stopped during the lockdowns because the government was paying them to dish out money from the government with no risk. That's all over. So we definitely want to see this going up, and it is. Okay, consumers are growing their credit card balances and auto loans and everything else. So this is showing the recovery is still intact. Retail sales haven't crashed. A lot of people are fearful that with the benefits ending, we're going to see a huge crash in retail sales. So far, that's not occurred. If we look at the consumer spending, this is why stocks have been going up. Record earnings per share. Now, can this continue without either lots of jobs coming online or lots of government intervention? Probably not. You need one or the other. That's why it's so important that the government continues to spend money and people get back to work. Otherwise, this trend's likely to fall and you immediately get a stock crash. Okay, jobs openings are at record highs. Most people aren't wanting to go back to work. We're seeing wage pressure come in. So this inflation is starting to get sticky. Producer prices continue to rise. Jobless claims remain elevated above 300,000. We really want to see that go sub 200,000. Earnings up 0.6%, new print today. Salaries continue to rise, so the inflation is really hot. Now, are we getting more people back to work? And the answer is no. We actually had labor force participation fall. So this is problematic. We definitely want to see this start to grow to believe we have a strong labor market recovery that could sustain tightening of monetary policy. So far, that's just not the case. Okay, record new trade deficit. This is what makes the dollar go down. Run huge deficits and ship all your money off to foreigners. And that's how we're really positioned, is to believe that this is going to continue. Now, what would reverse this? You need more of a populist agenda, bring the manufacturing back, put tariffs up. It's rough on the economy in the short term, but could strengthen your labor markets long term. So that's absolutely not happening. And I don't anticipate that happens until 2024 at the earliest. So we want to bet down on the dollar in general. And that's exactly how we're positioned across the board. Okay, no crash in income yet. Some canaries in the coal mine to keep a close eye on. Apple lost a lawsuit against Fortnite. That wasn't so great for them, but nothing too detrimental. Basically they were trying to force Fortnite to only take subscriptions where Apple pushes it through their store and gets 30%. And Fortnite was letting people subscribe on their website, cutting Apple out. And the judge did rule that they have to let them do that. What Fortnite wanted was for those rates to get much lower. But anyways, it was kind of a win-win for both parties on that front. Anyways, Apple is the biggest company in the world. If it's crashing, we've got problems, nothing to be worried about there. Tesla is, in my opinion, extremely overvalued and a huge risk to lots of ETFs. So if we see it falling off a cliff, I do believe it can create systemic problems. Nothing happening there. Specifically, it could cause problems for Cathie Woods, which is a extremely oversubscribed ETF that's betting the farm on extremely risky companies that will get demolished if interest rates rise, which is exactly what I think is coming. So yeah, she's been having a bad performance this year after some very extremely great performances when we had a different regime in inflation. Okay, Tencent stabilizing. This is a huge Chinese software company we have exposure to with EDC. Alibaba stabilizing. Again, it's important to see these champions of China not crashing. Samsung's been selling off, so we're seeing some weakness out of that, keeping a close eye on it. Toyota, record levels, doing very strong, nothing to freak out on that. So in general, market risks remain low in the very short term, even though we see some pretty big problems ahead. China's PMI jumped above 50. This was scaring everybody. Their credit impulse was falling, but we know they were trying to just clean up their economy and guide the society with the Communist Party's vision. So whether you like it or not, that's what they're doing. And we're going to see if China takes over the global power in the next decade. And it's unfortunately starting to look more and more like they will. European PMI is still at really high levels. A lot of unhappy people about mandates, passports, things of that nature, slowing their recovery. But in general, nothing to freak out about that. Here's a look at those Chinese imports and exports. You can see this is the best economy China's ever had in its entire history. So we're not worried about China from that perspective. Buy the dip. Same for exports. So global economy is still hot. Okay, great. Not too much inflation if you believe their reports. What about central bank balance sheets? Here's the US. All this talk of tapering, well, they're going to print the highest print just in the last week. So far, they're just printing, keeping rates lower, forcing us to invest exactly the way we currently are. Okay, ECB still printing away. So the big banks are still printing, even though they've been talking about tapering. And Bank of Japan, same thing. Okay, great. We're going to hop over to some news. I'm going to take a quick look at comments, and then we'll jump into the news. Okay, not a whole lot of questions today, so no problem. Let's keep on rolling. Okay, so I haven't listened to Biden's speech yet. I'm expecting he's going to blame the poor recovery on people not taking the medicine and Congress not passing a spending package. So we'll see if that's the case. And then again, we've already discussed what's important about that. Okay, economy only added 194,000 jobs. Richest Americans are fleeing treasuries. A little late. We were out in March of last year. When they do QE, you don't want to own treasuries. You want to own stocks, commodities, and cryptos. And when they end QE, you do want to own treasuries. So it's kind of funny. You want to do the opposite of what the Fed's doing. These are people predicting we'd have a weak report. Here's the GOP members who potentially are not real Republicans. They just gave Democrats a huge bone last night. And again, that's what we predicted would happen. So if you want to read that list, you can come on this. They got 61 yeses. They needed 60. So there you go. They're not going to default on the debt. Some Republicans are upset. Some people are predicting McConnell will lose his leadership role after the midterms. We will see how that plays out. Let's see what else we have that's notable. That was the main thing. Here's some look at shipping costs starting to fall, showing the weakening economy with GDP falling from 7 expected to 1.5 currently. Stephen Van Meter says 7 million people lost unemployment benefits in the last 2 weeks. Powell is expecting most of them to have jobs by the November FOMC meeting so they can taper. And again, maybe they will. So I'm open-minded to that. Here's a look at that. Benefits just falling off a cliff in the last 2 weeks. Will this get people back to work? We will see very soon. CIA says that a lot of our informants have been getting executed in China and Iran. Interesting headline out of that. The fight between the moderates and the progressives continues. I believe they will pass a deal for $2 trillion in mid-December, and that this is all noise at this point. So that is the big headlines. Very good. Okay, so I'm going to go ahead and switch to this real quick. We're about to review asset allocations. Okay, but real quick, if you're not a paid member, just one last little blip. This is where your video ends. So again, if you're not paid, call John, 505-610-1334. What we're going to do now is go through the exact formula for how to invest your money with our top selling advisories and talk about the potential trade alert we're going to make if a crash is coming. And that could be coming in November if we have a policy mistake from the Fed by tapering with not enough jobs added. So very good. I'm gonna go ahead and stop the recording on my side and then continue. So we're still recording for the paid folks. Okay, so very good. So, all right, we're gonna go ahead and look at some more content now. So just to review, if we thought there's a crash, but we're not sure, but we think it's a pretty good chance, I'd be 50 defense, 50 offense. 15% in the UVXY, 15% in treasuries, 15% EUO, 5% in silver. And then I would spread out the offense for pro at least with UPRO, EDC, EFO, the triple Q, and NRGU. Something very similar for the other strategies, just playing reduce your offense and add up on the defense. Now, if I'm wrong with this setup, we can actually possibly break even or make a small profit. Now, if I thought we had a very, very high probability of a crash, I'd probably just stick to the triple Q and the NRGU at 20%, and then I would double your dollar and your treasury position. Probably wouldn't go higher on the UVXY. So that's what I'd look at. Ed says, with inflation running hot, do we have no choice but to keep printing in order to service the debt? Yeah, long term we do, you're right. But they want to taper and slow down the inflation because that'll crash the economy on its own as well. Okay, so let's go ahead and look at the strategies broken down and what we're anticipating. Okay, so for the Warren Buffett strategy, Safe Alpha, we have a small hedge with 3 shares. Now remember, we're following a ratio of shares. So if I punch in 25,000, it's going to divide it by the unit cost and then multiply it by the ratio. So right now the ratio is 3 UVXY, 5 triple Qs, 1 GBTC, 2 UGL, that's gold, and 2 oil and gas, NRGU. So it's just multiplying it across. We're not chasing an asset allocation percentage. That's going to go up and down on its own. So yeah, that's really what we're looking at here. Now, if you're a paid member, you have a membership area and you can actually log in and punch in your numbers and get a trade alert. Plus you can speak to Victor, your customer support rep right there. We've added that. Okay, so you just log in, click on the position calculator, you have your strategies, and you can punch in how much money you want to invest and it will print it out right here. This one's just a little easier to view for the recording. Okay, so Safe Alpha, if we see robust labor recovery and we see the reverse repo fall below 750 billion, I will reduce your exposure in the NASDAQ. I don't think that's going to happen till February or March. So to answer Eddie's question, no, I don't think we're about to see tech crash. In fact, I think we're going to possibly have a really weak 5 months of labor. Interest rates remain low, and we could see actually tech and our oil play do well simultaneously. So you get your cake and your icing and all the goodies in between. I forgot that saying, but yeah, I don't see any reason to freak out till late November. So I see very few changes to Safe Alpha, really none right now. Now, if we get the hint that labor is really hot and recovering in October, and we can predict a really strong jobs report and that we're going to taper, then we can look at what we would want to do. Probably reduce tech. Have your cake and eat it too. There we go. Thanks, Dean. Okay, high risk portfolio. This is the one you're getting on your free trial. It's just been smoking the S&P 500. no changes here. I probably want to get some more rare earth metals soon as we see the, soon as we think oil's topping out, which we don't think is the move right now. So we've just had massive gains in everything in this portfolio. Right now, your strategy is to have 12 shares of UVXY, 62 shares of Ethereum, 6 shares of NRGU, 3 shares of rare earth metal. Okay, Safe Growth Pro is your Ray Dalio strategy. Right now, we have 3 shares of UVXY, 2 shares of North America S&P 500 times 3 UPRO, 2 shares of EDC. I would like to add to that one soon. We've got 4 shares of EFO for Europe, Japan, Australia. We're not in gold or rare earth metals in this portfolio currently. We've got a small Bitcoin play, a small silver play, and a big oil and gas play. So that's your breakdown for Pro. Bootcamp Core finally kicking some butt. Patience, a lot of patience required, but it's doing what we expected. This portfolio loves government spending money. Okay, so it's predicting the spending's coming through. We're getting back towards those double-digit monthly returns here. Only trade I see for this is I'm losing my patience with MJ, and I know uranium is a rock solid long-term play. So I'm probably gonna get us into uranium soon. I know solar is gonna be a huge play for decades too, so I'm gonna be patient with that one. Right now in Bootcamp Core, we have 4 shares of UVXY, 8 shares of FNGU. Okay, so that's like the triple Q, except it's only 12 companies. It's outperforming the triple Q by many multiples. And it has 2 Chinese companies, Baidu and Alibaba. Now, I'm a bigger fan of Tencent than Baidu, but again, extreme discounts. I think FNGU is going to smoke the triple Q as China rebounds in the near future. So love that play. Love our oil and gas play. I love our solar play, even though it's been very hard over the last 6 months. But again, buy the dip, great deal on that one. GBTC is probably getting ready to lead crypto higher. I actually think this will be your best performer until we probably get past 60,000. We'll see where it ends up stabilizing. But really excited for that. MJ has just been a dud. The fundamentals have been great, but it's just not getting the stock promotions. We know Bill Gates is pumping uranium and nuclear power. So I'll probably make that call next week and just get you ready for the next inflation play. So that's the breakdown of strategies. Let's look at the monthly breakdown. Now, Pro was smoking the S&P 500 all year, and then we got hit in the head with the variation causing lockdowns all over Asia, and our interest rate play and our commodity play got smashed in July and wiped out our outperformance. So July, August, September made us look like we're underperforming these indexes, but that's quickly turning around. No changes, and we're getting ready to just have a blast off in this portfolio to close out the year. So really excited for Pro to just dominate the rest of the year. And it's really set to jet for many years to come. So it's a global portfolio, Ray Dalio strategy. The best bet if you have a lot of money and you want to be highly diversified, not just bet on one index. Now, Safe Alpha is having a ridiculous 9% return in October. It had the same problem in July, September. Our NRGU position got punished, but your NASDAQ did well. Currently up 17% year to date. Beautiful return. Nothing to really worry about on this one, just set to jet. High risk portfolio, smoking everything, 273% return, 20% return in October. And then our Bootcamp Core, which had double-digit returns when we were passing stimulus, November, December, January, February. And then got whacked over the head due to China crackdowns and due to the commodity crash. Lost a lot of its outperformance. Told you guys to be patient, wait for the stimulus to come through, do nothing. And now we have this huge 11% print. And again, I believe we're going to see double-digit returns. So a lot of people want to look at year-to-date performance, look at what has the best return, and assume that's the best portfolio today. Not necessarily the best way to look at the future, because we need to anticipate what's going to happen, not what has happened. Okay, beautiful, guys. So we'll go ahead and do some Q&A and throw up John's number for the weekend. And we'll bring back everybody. Steven says, why has MJ not done well? Yeah, not the stock promotions. So it might do really well after stimulus comes through. So we'll keep a close eye on it. And we'll bring Dean on there. Dean.
Hey, Jason, how's it going?
Going great, buddy. How are you doing?
Oh, it's another lovely day in Florida.
Yeah, I bet.
Yep, having some fun, enjoying the weather. Yeah, everything's good. Everything's good. So, folks, just really quickly want to introduce John. Okay, if you haven't called John to chat with him yet, like he's a really neat guy. He's really doing a great job helping a lot of his clients get invested behind our strategies. So give him a call, guys. It's really cool. I basically got to the point where I was too busy to handle all the incoming call volume. So I had to bring on John. Basically, we were kind of forced to do that. Now, one of those things where, boy, was that an incredible opportunity for you all as investors. Okay. So give John a call. His number is 505 610 1334. Okay. He'll be more than happy to help you out, guys. He'll be happy to get you a lifetime membership, or he can also do the annual membership if you want to start there. Okay. But give him a call. He looks forward to it. It's 505 610 1334. And John, super happy to have you on our team, bud. Okay, guys. Now just really quick here too. Let's see. There's a few people in there. Let's see here. So I want to thank specifically some new eyeballs in here. Let's see. So Alicia, appreciate your time to join us here. Emdrit, thank you for joining us. Chona, welcome, welcome, and thank you very much for joining us. Dennis, thank you kindly for your time. Gerard, thank you very much for joining us. Greg, great to see you in here, bud. Hope all is well at work there. Okay, Jan, thank you kindly for joining us here today. So, guys, when you're ready to switch to a lifetime fee, never have another fee again for the rest of your life, give John a call. 505 610 1334. Jason, I think that'll do it for us, bud.
All right, guys. Well, you have a wonderful weekend. We'll be back on Tuesday. And don't forget, leave a comment below to win a prize. And yeah, beautiful. All right, I'm going to go ahead and put up our disclaimer here just to keep the SEC off our butt. But yeah, we're one of the more conservative, safe setups you could possibly invest in with crash insurance and the whole work. So thank you guys so much. Really, really enjoy what we do here. And we look forward to taking care of everyone. So thank you, Dean. Thank you, John. Thank you, Victor. And thank you, everyone, for joining us live. We'll see you back on Tuesday.
All right. Thank you, Jason. Look forward to speaking with you all. Have a great day. Just really quick, Jan, I just sent you the link. And I'm going to go through the list here. Greg, H-Win, I just sent you the link. Gerard, send you the link now. Okay. Let's see here. Who else? Dennis, sending you that link too. Okay. Emrit, sending you the link now.